an, an intelligent investor. Commentary on chapter 3. You've got to be careful if you don't know where you're going, because you might not get there. Bull market belonging. In this chapter, Graham showed how prophetic he can be. He looked 2 years. Oh, yeah, I forgot. He looked 2 years ahead, foreseeing the catastrophic bear market of 1973 to 1974, in which U.S. stock lost 37% of their value. He also looked more than 2 decades into the future. Eviscerating logic of the market gurus and best-selling book that were not even on the horizon in his lifetime. The heart of Graham's argument is the intelligent investor must never forecast the future of exclusively by exploiting the past. Unfortunately, that's exactly the mistake that one period after another made. In the 1990s, a stream of bullish books followed Wharton Finance Professor Jeremy Single, Stock of the Long Run. 2 decades. The heart of Graham's argument is that the intelligent investor must never forecast the future exclusively by extrapolating the past. Unfortunately, that's exactly a mistake that one period after another made in the 1990s. A stream of bullish book followed Wharton Finance Professor Jeremy Single, Stocks for the Long Run, in 1994, called Sublimating into Wild Croissant with James Glassman and Kevin Hassett, Doe 36,000, David Elias, Doe 40,000, and Carl Cadlick, Doe 100,000, all published in the 1999. 7% of inflation ever since 1802. Therefore, they concluded that's what investors should expect in the future. Some polls went further, since stock had always been bonds over any periods at least 30 years. Stock must be less risky than bonds or even cash in the bank. And if you can eliminate all the risk of owning stocks simply paying on them long enough, then why? Probably over how much you pay for them in the first place. To find out why, see the sidebar on page 82. In 1999 and early 2000 bull market, Bologna was everywhere. On December 7, 1999, Kevin Lattice, portfolio manager of the First Hand Mutual Fund, appeared at CNN's Moneyline telecast, asked if wireless telecommunication stock were overloaded with many trading at inflation multiplier of their earning. Lattice had already answered, "It's not a mania," he shot back. "Look at the outright growth. The absolute value of the growth is big." On January 18, 2000, Robert Foliage, chief investment strategist at the Kemper Fund, declared in the Wall Street Journal, "It's a new world order. We see people discard all right companies with the right people with the right vision because their stock prices is too high. That's the worst mistake an investor can make in the April 10, 2000 issue of the Business Week. Jeffrey M. Applegate, then chief investment strategy at Lamb and Brother, asked stereotypically, "Is the stock market riskier today than 2 years simply because prices are higher?" The answer is no, but the answer is yes. It always had been. It always will be. And when Graham asked, "Can such headlessness go unpunished?" he knew that the internal answer to that question is no. Like an emerged Greek god, the stock market crushed everyone who had come to believe the high return in the late 1990s were some kind of divine right. Just look at how those forecasts by Lattice, Froelich, and Appledge held up from 2000 through 2002. The most stable of the Lattice get wireless stock. Nokia lost only 67%, while the worst, Western Communication lost, oh my god, 99.9%. Froelich's favorite stock, Casio System and Morley, fell over the 70% by late 2002. Investor lost over $400 billion on Casio alone, more than the annual economic output of Hong Kong, Israel, Kuwait, and Singapore combined. Oh my god, that is a lot. In April 2000, when Applegate asked a racial question, the Dow Jones Industrial stood at 11,187. The NASDAQ composite index was at 4,446. By the end of 2002, the Dow was hobbling around 8,300 level, while NASDAQ had withered to roughly 1,300, eradicating all its gain over the previous 6 years. Survival of the fattest. There was a fatal flaw in the argument that stock have always been bonds in the long run. reliable figure before 1871 do not exist. The indexes used to represent the U.S. stock market earliest return contain as few as 7. Yes, 7 stocks. By 18,000, however, there were some 300 companies in America, many in Jeffersonia, equivalent of internet, with interns and candles. Most went bankrupt, and their investors lost their niggers. But the stock indexes ignored all the companies that went burst in those early years. A problem technically known as survivorship bias. Thus, these indexes widely overstate the result earned by real-life investors who lack the 2020 hindsight necessary to know exactly which 7 stock to buy. A lonely handful of companies, including Bank of New York and GP Morgan Chase, have proposed continuously since the 1790s, but a very much miraculous survivor. There were thousands of financial disasters, like the Dismal Swamp Canal Co., the Pennsylvania Cultivar Vine Co., and the Snigger Gap turn by Co. all omitted from the historical stock indexes. Jeremy's signal data show that after inflation from 1802 through 1870, stock gained 7.0% per year, bonds at 4.8%, and cash 5.1%. But Roy Dimson and his colleague at London Business School estimated that 1871 stock returns are overstated by at least 2 percentage point per year. In the real world, when at least 2 percentage point per year in the real world, then stock did not do better than cash and bonds, and perhaps a bit worse. I don't know. But Roy Dimson and his colleague at London Business School estimated pre-1871 stock return are overstated by at least 2 percentage point per year. In the real world, then stock did no better than cash and bonds, and perhaps a bit worse. Anyone who claimed the long-term record proved that stock are guaranteed to outperform bonds or cash is an irate. The higher they go, the harder they call.